Hello there, I'm Ameera David. This is Boom Bust, and these are the stories we are tracking for you today. Chinese investors clear a key hurdle to buying one of America's oldest stock exchanges. Details on the history that could be made coming right up. Then Brazil closes its wallet for, get this, 20 years after enacting what's being called the harshest austerity program in the world. We'll take a look at some of the fallout straight ahead. Plus, Trump's economic team is taking form. Who's involved and what might it say about U.S. economic policy ahead? Ed Harrison breaks it down in The Big Deal. That and more all lined up for you on today's show. Don't go anywhere. It all starts right now. Chinese investors just moved a step closer to buying one of America's oldest stock exchanges. Those investors, led by Chongqing Cason Enterprise Group, just cleared a major hurdle in their acquisition of the Chicago Stock Exchange. We're now learning that the Committee on Foreign Investment in the U.S., which reviews these type of sales, has given the deal the green light. The next hurdle to clear is approval from the U.S. Securities and Exchange Commission. But if that goes through, we're looking at the first sale of a U.S. stock exchange to investors from China in history. The merger is meant to provide a way for Chinese companies to list in the U.S. while also opening the door for Chinese investors to buy U.S. listed shares. But the sale hasn't come without its fair share of opposition. Last February, a group of 46 lawmakers wrote a letter urging the deal to get tough scrutiny from the committee over concerns of potential corporate espionage. The worry was that this would give the Chinese government greater access to the data of U.S. companies. But in the end, of course, the committee did give this deal a green light, further paving the way for an injection of cash into the exchange's flagging business. Keep in mind, the Chicago trading platform has lost a lot of steam in the last several years, falling from a market share peak of 10.6% in 1989 to less than 1% this year. While recovering from a nationwide scandal can take time, especially for financial institutions. But if that scandal develops, as it has for Wells Fargo, recovery time takes even longer and gets more expensive. Boom Bust, Bianca Facchinei has the details.
After news broke of Wells Fargo's account scandal, everyone expected to see the bank take a bit of a hit financially. And that's exactly what happened. Just a month later, the number of bank account openings and credit card applications fell dramatically. As a reminder, this came after the congressional hearings, federal investigations, and ouster of the CEO. But it still doesn't look like Wells Fargo has actually hit rock bottom yet. On Friday, the bank announced that new checking account openings declined by 41% in November and fell 9% from October. And that's not the only sign of struggle. Interaction with branch bankers dropped by 14% since last year. In a very brief statement addressing this, CEO Tim Sloan said, "We were pleased that in November our existing customers continued to actively use their accounts and valued their relationships with Wells Fargo. We remain focused on meeting our customers' financial needs by providing great service and quality products." The only glimmer of hope in the recent data is that credit card applications jumped 3% since last month. But we also learned earlier this year that the scandal allegations got worse. Employees allegedly signed customers up for life insurance with Prudential without their knowledge, just like they did with the bank accounts. And the bank was also punished by the Fed and FDIC for not passing the living will test, which led to a number of sanctions. There is time left to make up for the failed test, but the past few months have proven that it will take a long time to fully regain customer trust.
Indeed. Time is the key component needed here. And we know that Wells Fargo has also taken heat from opponents regarding their involvement with the Dakota Access Pipeline. Has that had any impact, as far as we know, on business?
So compared to the account scandal, the pipeline controversy hasn't exactly cut into business in the same way at all. It has received a lot of attention. But one thing that will be interesting to follow is that a councilwoman in Seattle just proposed a bill that would end the city's deal with Wells Fargo to manage some of their city funds over the pipeline, over their financing of the pipeline. And a few leaders in Minneapolis have suggested that they might propose the same thing. So if they do go through with legislation like that, it would certainly be significant, but still would not be nearly as bad as their account
Something
scandal
tells
right now.
me that Wells Fargo is going to be spending a lot of ad dollars to try to rectify their image. They're going to be in damage control mode for quite a while. All right, Bianca Facchinei, thank you so much for that. All right, a 20-year freeze on federal government spending. That's what Brazil now faces as new legislation dictates a spending cap that can only increase by the rate of inflation. The government says the dramatic move is necessary to get the country's recession-bound economy back on track and gain control over public debt. But there's also a lot of criticism. Joining me with more on this is RT's Lindsay France. She's joining us here in studio. And Lindsay, I want to ask you, I mean, Michel Temer, president of Brazil, he's been trying everything to really get this economy going again. It is just, unfortunately, deteriorating. Tell me about this measure. What do we know?
Right. You know, Brazil has been called the champion of football, and it's now being called the champion of austerity. This is the biggest set of austerity measures we've seen. Now, that means spending on government programs like education, healthcare, pensions, infrastructure, and defense will remain paused at 2016 levels until 2037. So get this, the cap doesn't increase if the economy grows to accommodate population growth, or even to allow more funds for the aging and for the young. Education, spending per child to drop, larger class sizes, higher costs for health expenditures and education. Patient expenditures to drop by 10%. So you can bet by 2037, effects will be felt in this country. But let's take a trip around the world on this, because we hear time and time again about austerity. Now, one of the most popular countries we hear about, Greece. Its debt obligations back in 2010 descended it into debt hell, so to speak. But bailouts from the IMF and the EU, the list goes on, other sources worked barely. Greece has trimmed pensions, but also medical spending, education spending, just basically across the board. Now get this. We're seeing a transfer of control of public utilities like water and electricity, the places that they supply Athens even. They are being transferred to asset funds. And of course, massive bailouts. Now we're talking about, so Brazil, Greece, Spain, teacher layoffs, increased class sizes, fewer extracurriculars, higher tuition fees. This is something that's going to be felt for generations. And of course, Spain has had massive unemployment. And then, of course, we go over to Ireland. Ireland has been a big problem for austerity measures. Now, if you consider the way it had been for a long time, the International Monetary Fund has commended it for its impressive economic recovery, strong job creation, strong job creations all the way around. Now, it went through a large crisis followed by austerity, of course, and wage cuts. But get this, the economy grew by 7% last year. That's faster than China. Unbelievable. So we advance over to Portugal. Of course, we see the tax hikes. We see the salary cuts for public servants. That was a big indicator to people that the government was taking it seriously when it wasn't just government workers, but government servants as well. So here we go around the world in austerity, but Brazil is taking the cake.
Yeah, and Lindsay, austerity does seem to be the common theme defining the global political economy, if you will. But let's go back to Brazil. I mean, what's been the overall reaction by Brazilians and also from the international community?
Well, as I said, it used to be football, now it's austerity. They're seeing, you know, as you said, President Michel Temer is grasping at everything he can. Obviously, a lot of public outrage. He's dealing with his own set of scandals right now. And, you know, former President Dilma Rousseff There's accusations she did a lot to hide it. This is not something that's short-lived. This has been going on for a while. There's a lot of fear, and of course the workers are on the streets because it's children, it's old people, but the workers are on the streets because they are supporting the children out there. So we're seeing obviously the same old. We're seeing a lot of public outcry, and you know, it's a time of year when this is the last thing people want to see. These clampdowns are going to keep coming.
Absolutely. This will be the big story for Brazil in 2017.
Right.
Let's see how it shakes out and if it potentially helps them. We will see.
Hopefully.
All right. Lindsay France, thank you so much. Still ahead here on Boom Bust, gold continues to tank in a post-election world, but our next guest says it's poised for a big comeback in 2017. Plus, the Trump administration's economic team is taking form. Who's on it, and how might they be able to challenge Trump's campaign promises? Ed Harrison will weigh in on the other side. Stay with us. And as we go to break, here are the numbers at the closing bell.
In the mountains, when a family doesn't have a male, female of that family assumes the role of the male.
Forget everything, she doesn't accept, she doesn't need money.
Vyšší Sibor.
Etaşçı, vyšší Sibor.
Armatosy.
Etaşçı, kishte një gun.
Go now, or I will kick your ass.
Kështu mu qeve një tiba, ding edhe që atëherë, vetëm berberkas.
Ma I rashkut me zjedhë që trukë, si jam se në me që burra.
ఇట్లా గేట్ పెట్టుకొని ఉంది గేటు డోరు దగ్గరికి లా ఉంది ఏంది తలుపు పెట్టేసుకున్నాం అంటే లేదు తీయనంటే తీసేస్తుంది మందు డబ్బా చేతులు ఉంది ఎందుకు ఇట్లా చెప్పక మా మరిది వాళ్ళు ఇట్లా వీళ్ళందరూ ఇక్కడనే ఉంటే మొత్తుకోగానే వచ్చేసిండు.
At the national level in the last 20 years, 2.9 lakh farmers have committed suicide.
BT cotton has been promoted as something which actually solves the problems of the Indian farmers. Something which comes as is thrust upon the farmers as a solution starts creating more problems.
Monsanto has created monopolistic control over the cottonseed market in India. Only BT cotton is available. Normal cottonseed is largely unavailable to Indian farmers.
Well, no surprise that gold has moved lower in the wake of a Fed interest rate hike. But what may be concerning, even more concerning for gold investors out there, is that the precious metal is down 11% since the presidential election. This as the Fed takes a more hawkish stance on lifting interest rates in 2017. It's prompting analysts out there to turn bearish on the commodity altogether, and that includes trader Tim Knight, who said recently that he believes it's going to be a miserable 2017 for the yellow metal. It's just about the only asset that's reliably down every day. So does he have a point? I toss that question to Euro Pacific Capital CEO Peter Schiff, a known gold bull. Here's his take.
Not really. I mean, I think, he's completely wrong, but I like to see that negativity out there. I mean, gold has gone down quite a bit since the election, but I mean, if you go back over the last 15 years, gold's had a pretty good track record. And it's interesting that the reason that so many people have turned bearish on gold is because they believe that we're going to have more inflation under Donald Trump, that we're going to have larger deficits as a result of tax cuts and increased government spending. and that because of the higher inflation, the Fed is going to get more aggressive and raise interest rates, and somehow the increase in interest rates is what's going to be bad for gold. This is ridiculous. Higher inflation is good for gold, and even if the Fed is raising rates slightly, even if it manages the 3 hikes that people think are coming next year. And remember, they were telegraphing 4 hikes this year, and they only gave us 1 in December. And the Fed is actually less optimistic on the economy now than they were a year ago. If you look at their GDP forecasts, I even doubt we're going to get those hikes. But even if we do, I think inflation is going to rise much faster than interest rates, and so real interest rates are going to fall, and that's when gold shines brightest, when you have inflation that is not being fought aggressively, like during the Bush term when Greenspan was raising rates every quarter, every time they met, and gold prices went from under 300 to 1,000. Or if you go back to the 1970s when the Fed was behind the curve on inflation, and gold went from 350 to 850, or from $35 an ounce to 850 while the Fed was raising rates. So I think the idea that higher inflation is bad for gold is preposterous. I think they're right, we're going to get more inflation, but it's not a negative for gold, it's a huge positive. And the markets were wrong about gold at the end of last year.
Yeah.
They sold it off when the Fed raised rates. It bottomed out in January and then had a huge run. I think we're going to have another big run next year, but I think next year we're going to finish the year strong as opposed to have this Trump-related sell-off.
But a lot of people look at this, Peter, and they say just because, you know, the Fed wrongly predicted 4 hikes, we only got 1 hike, just because that didn't work out doesn't mean that that's what we're going to see in 2017. They would argue we're on to new times. They're looking at the data out there. They're looking at GDP showing, you know, solid growth, over 3%. They're looking at corporate profits continuing to rebound. So how can we confidently buy into the theory that we are on to a gold bull run? Or do you not necessarily think that's the case anymore?
Well, first of all, GDP growth for this year is going to end up below 2%. And the Fed is only forecasting 2.1 for next year. And I think they're too optimistic. So we're not getting 3%. We'll be lucky if we get 2%. We may not even get that. We could be on the cusp of a recession right now. It wouldn't surprise me to have a recession early in the first year of the Trump term. And I think the reason that the Fed waited until December to raise rates by 1/4 is because, in contrast to their claims to have confidence in the economy, they have no confidence in the economy. That's why they waited so long, and that's why they raised interest rates so little. Remember, when Alan Greenspan cut interest rates to 1%, in the aftermath of the tech bubble bursting and September 11th, he brought interest rates to 1% because he was so worried about the economy. Now the Fed is supposedly so confident, and they can't even raise interest rates above 1/2. This is a complete bubble that the Fed has blown. You know, Trump was right when he was a candidate. It's a big, fat, ugly bubble. It's even bigger, fatter, and uglier now. And it's not just the stock market. And by the way, the bond market bubble has already burst. And so interest rates are rising, and that is going to compound the problems for an already weakening economy. So if the economy was weak last year, it's going to be even weaker next year.
Now, you've expressed some concern in the past for the impact of a Fed rate hike on the housing and auto sectors more specifically. What do you see as the vulnerability there?
Well, these sectors are completely dependent on cheap money. I mean, people buy houses based on their monthly mortgage payment. And fixed rate mortgages, the 30-year fixed rate has basically gone from about 3.5% when Trump was elected to 4.5% now. It could be over 5% by the time he's inaugurated, and it can easily be close to 6%, next year. I mean, nobody can afford these rates. We already have home ownership near a 60-year low because people can't afford the low rates we had. Obviously, they're not going to be able to afford the higher rates that we have now or the rates that we're getting in the future. So you're going to see a drop there. You're going to see a complete end of the refi market. So that lifeline is gone. People are able to rely on lowering their payments with refis. Nobody can do that anymore. And I think now, with a higher cost to borrow money to buy houses, Real estate prices are going to start to fall, so that means more foreclosures again, so that's a problem. And the auto bubble, this has all been about 0% down, letting people roll the negative equity in their trade-ins into an even bigger loan with cheap money. It's been about leases and extending the payments. This is a huge subprime bubble, and the air is already coming out of that.
Yeah.
So all the things the government propped up with cheap money are going to topple as you take the cheap money away.
Okay, when I interviewed you back on Election Day, you talked about how traders had decided a Trump win was bad for stocks, good for gold. That was certainly the consensus at the time, but as we know, the opposite has turned out to be true. Investors are seemingly bullish on a Trump economy. So what are your thoughts there? Because it sounds to me that you're bearish on the economy, but you do seem to be a little bit more upbeat about Trump. Can you be bullish on Trump, bearish on the economy? Where do you stand?
Well, first of all, that was the original reaction, right? I mean, as soon as Trump won, the stock futures were down, whatever, 800 points. Gold was up $60. So that knee-jerk reaction was there. But if you remember, I said I didn't understand why people thought that Trump was worse for the stock market than Clinton, because I said Trump is promising things that would normally be good for the stock market, like less regulation and lower taxes. But the problem is the stock market is already overvalued. It's a bubble. And so just because we're going to get some tax cuts and regulatory relief doesn't undo that bubble. I mean, it helps, but it's not going to justify the inflated valuations. And of course, as interest rates go up, that automatically brings stock values down. But I think it's also interesting that the same stock traders that were so worried about what would happen to the market if Trump won, the minute he won, now they just started buying, because all they want to do is justify a move up. Believe me, had Clinton won, they would have said, oh, we dodged a bullet, let's buy stocks. You know, we dodged Trump. You know, this market is feeding on itself. You know, it's like a horse with a bit in its mouth, and it keeps on going. People are ignoring that the things that they think are going to happen are impossible. They think, oh, now we're going to get fiscal stimulus, so we don't need monetary stimulus. You know, if we get the fiscal stimulus, we need monetary stimulus more than ever to make it possible. There is no way to finance these deficits unless the Fed steps up and does it. Now, of course, this is a mistake. They shouldn't do it. That's why we're in so much trouble. But I don't think there's any way Trump can fix these problems. They are unfixable. We can't stop the bubble from popping, nor should we try. You know, Trump was elected, and I was saying I thought he would get elected because the economy is so messed up.
All right. Big deal time. Sitting here with Ed Harrison, we're talking about Trump's economy to continue the conversation we just were having with Peter Schiff. Now, we have a fairly good idea of what Donald Trump's economic team will look like. We know corporate titan Wilbur Ross is the nominee for Commerce. Former Goldman exec Steven Mnuchin is the nominee for Treasury. And Goldman exec Gary Cohn will lead Trump's National Economic Council. We're also hearing that former Bear Stearns chief economist Larry Kudlow will be the chair of the Council of Economic Advisors. And those appointments may tell us a thing or two about what to expect going forward. So, Ed, let's start right there. Let's start with Steve Mnuchin, because what he has said that has been sort of the hallmark of his, the framework that he has put forward so far is, quote, our #1 priority is tax reform. Talk about that.
Yeah, so, and by the way, we have a few charts while I'm talking. Hopefully they'll be able to put them up on Steve Mnuchin and then also on Larry Kudlow and Gary Cohn, what their general sort of outlook is on some of these issues. But I wanted to start out with why he's talking about tax reform, and that's because he's basically a supply sider. Kudlow, who's up on the screen right now, is a huge supply sider. And basically, in terms of supply side, what it really is all about is about capital formation. The whole concept is that over the long term, you want productive capital formation, and in order to have that productive capital formation drive growth, you need to have lower taxes and you need to have lower regulation. So when he says that tax is #1, that's basically what he's talking about. Now, the negative side of that is the sort of stuff that you heard the last, when supply side first started back in the early 80s under Reagan. Here's what David Stockman said, who was Reagan's chief guru back in the day. He said, quote, the supply side formula was the only way to get tax policy that was really trickle down. Supply side is trickle down theory. That's what he said. Okay. So the problem is that you're giving tax cuts to business owners, the rich, if you will, and that trickles down to everyone else. That's what the left would say, that's what Keynesians would say, and that's where the tension comes.
Yeah, that's the dilemma, is what happens to the middle class when you do that.
Right.
What kind of growth do you think they can actually get, though, if we do see enough productive capital, if you will?
They're talking about getting 3 or 4%. So they think, and you know, if you've listened to interviews, Steve Mnuchin says point blank, if we have productive capital investment, we can get sustained. We're not talking about, you know, peak. He's saying sustained 3 or 4%.
Okay. I mean, just several months ago, 4% sounded a little, you know, a little ambitious.
No,
now
you know why?
it may
Because
not.
we spoke to Gerald Friedman. Do you remember that's the guy who said Bernie Sanders' plan could get a sustained, you know, 3 or 4% growth? And even people on the left, like Paul Krugman, were saying that's laughable. No way. These guys are saying the exact same thing.
You think it's feasible, 4%?
You will find out.
Yeah,
you know? I'm not going to take a view, but I think it'll be difficult.
Okay, so one of the things that these guys all have in common is that they are not protectionists. Okay,
right.
So the question is, how does that square away with Trump's trade policy?
Yeah, I think that is a bit of a problem. The thing is they talk about fair trade. I'm trying to look and see if I have in my notes anything about what they say about fair trade. Oh yeah, I do. Here's one from Stephen Mnuchin. He says, we believe in fair trade, and we think that's going to be a big boost to the economy. And you know, if you listen to Ross and you listen to Mnuchin, what they're basically saying is we want deals that work bilaterally for both sides. That is all these big regional block deals like TPP, they're all wrong because, and Wilbur Ross said this specifically, and he's going to be big on trade. You know, you do deal with country number one, and they rake you over. Then you go on to number two, and they insert their little stuff, and then number three. So he says, no, bilateral trade, and it has to be fair, and that's how we're going to do it.
Okay, so just country to country versus these large, you know, sweeping trade deals that we see, such as with the TPP. In that realm, I mean, could you see somebody like Trump doing a deal with the UK, for example, in a post-Brexit world?
Exactly, and that's the point, you know, the bilateral as opposed to the regional. I think, especially because the UK wants to move into sort of an Anglo-Saxon, Anglo-American type of environment, Canada, Australia, New Zealand, that they'd be open to that. They're going to be reaching out to Trump, no doubt, because that's their policy.
What about Mexico, our neighbors to the south? We have a lot of tension right now with the rhetoric coming from Donald Trump. What do you think will happen there?
I heard something that Wilbur Ross said, and I took some notes, and I thought it was interesting. Here's what he said. He said Mexico has 44 treaties with other countries that make it very advantageous to do international shipping from Mexico rather than from the United States. Believe it or not, Mexico has better treaties with the rest of the world than the United States. We are going to fix that. So basically what Wilbur Ross was saying is that it's not that we want to be a protectionist against Mexico. It's that we want to do bilateral deals that are as good as the deals that Mexico has done. And we, that is, under the Trump administration, are going to make that happen.
And what about spending? We're running out of time. He has bold fiscal spending plans. He's up against a Congress that are fiscal hawks. How does that square away?
I think that he's going to have to give them something. Basically, you know, he can't do tax cuts to the middle class, huge business tax cuts, unless in some way he gets rid of enough deductions, simplifies the tax code enough to make sure that it's relatively revenue neutral. You can get some supply side sort of, you know, the tax cuts pay for themselves type of stuff out of the Republican Congress. But, you know, they're not going to allow him to potentially.
So you think they're going to rein in his policies a little bit going forward? And if you look at the people that he is putting in place, it seems that he might be moving away from some of his rhetoric. That seems to be the case.
Without a doubt.
We're out of time. Ed Harrison, thanks for that. We love hearing from you guys. Make sure you tweet at us. Make sure you check us out on YouTube. Have a wonderful weekend. We'll see you next time.